China is no longer trading as a single story. What investors are pricing now is a market being pulled in different directions at once. What investors are pricing now is a market being pulled in different directions at once. An external energy shock, a still uneven domestic recovery, and a widening gap between companies that can absorb higher costs and those that cannot. Start with the external shock. The war involving Iran and repeated disruptions around the Strait of Hormuz have injected fresh volatility into oil, shipping, and industrial inputs. That matters far beyond the energy sector. The Strait still carries about 1/5 of global oil and petroleum product consumption and around 1/5 of global LNG trade, which means every escalation can quickly feed into costs, freight rates, and margins across Asian manufacturing supply chains. But the more important question is how that shock is landing inside China. The internal landing within the Chinese supply chain, March's data sent a mixed signal. Exports rose just 2.5% year-on-year, while imports jumped 27.8%. Producer prices also rose 0.5%, ending more than 3 years of producer price deflation. Still, that should not be mistaken for broad-based reflation. In the same March data, producer prices for means of production rose 1%, while producer prices for consumer goods were still down 1.3%. That suggests upstream cost pressure is recovering faster than the actual downstream demand currently seen in local Chinese consumer markets. To be fair, 1 month should not be overread. Part of the export slowdown likely reflected calendar distortion from a later Lunar New Year and a tougher comparison base from March last year. And the import surge does not automatically mean household demand has fully recovered. In the first quarter, China's retail sales rose only 2.4% year-on-year, while March retail sales grew 1.7%. That is why the market is diverging so sharply. Companies with pricing power, resource exposure, or strategic positioning can still look resilient. Businesses tied to weak consumer demand, thin margins, or heavy input costs remain more vulnerable. So this is not simply a call on whether commodities rise or fall next week. It is a question of where imported volatility lands first. In raw materials, in corporate margins, where the scale of operations is significant, or in overall investor confidence. Until that becomes clearer, the real China story may be not direction, but dispersion.